Welcome to our Taking Stock video for the week ending the 14th of April 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and joining me today is our Equities Analyst, Daniel Ortisi, to stream to you all things share markets. Welcome, Dan. You had a few days off this week in Adelaide. How was it?
Yeah, it was fantastic, Kien. Got to go down and visit the old Penfolds estate there in McGill and help support our fellow shareholders at Treasury Wine. So had a great time off.
Oh, wonderful. Treasury Wines, it is a borderline star growth stock, and we'll talk briefly about it later on in this episode. But before we get started, just a reminder that the information provided today is of a generic nature and therefore isn't considered personal advice. Remember, shares are volatile, so any charts and tables presented here today shouldn't be relied upon as a guide for future performance. Well, Dan, inflation is back in the spotlight, but the good news is that the peak in inflation rates may have passed. In the US, the headline CPI figure, it rose by about 5% in the year to March, and that's well down on the peak at 9.1% in June. However, this doesn't really mean that the US Fed will keep interest rates on hold, does it? In fact, the core inflation rate at 5.6%, that's still well above the Fed's inflation target of around 2%.
That's exactly right, Kian. And just further to that point, although lower interest rate expectations, are theoretically positive for share markets, the reality is that, we don't really know where share markets will move. In fact, declining interest rate expectations would actually suggest that economic activity could slow significantly, which is actually making it really difficult for companies to therefore generate profits.
That's right, Dan. And contrary to popular belief, a recession in the US or Australia does not necessarily translate to negative returns for the share market. So don't, be too negative here. In fact, looking back at the past 11 recessions throughout history, markets have been positive 45% of the time, with returns on average being quite flat. And you can see this with the table on screen right now. There is practically no correlation between recessions and share market returns at all.
And with this in mind, Ken, we believe that it is absolutely pointless to try and time the market. Warren Buffett reiterated his long-standing philosophy that he does not make any investment decisions based on macroeconomic factors. Instead, a better way to manage your portfolio is to focus on what you can control, and that is risk management. Invest according to your stage of life and tolerance to volatility. Within equities, maintain a diversified portfolio of at least 15 stocks, and of course, investing in financially healthy businesses that can withstand the challenging economic conditions.
Yeah, that makes sense, Dan. But also historically as well, and looking at that table, recessions usually represent a wonderful time for investors to look for opportunities in the share market. As you can see from that table, in the first year following a recession, share markets have rallied 91% of the time and generated an average return of around 16%. And that's great statistics there. And the best time to look for those opportunities is when the companies release their results or provide market updates.
That's right, Kian. And moving on to the US this week marks the start of the first quarter reporting season. It will be interesting to see how the US banks will fare following the global banking crisis last month. The earnings for the sixth biggest US banks are expected to be down by around 10% year on year, and this will obviously affect the volatility of our banks and our local market here in Australia. Although our analysis indicates that our banks are in a much stronger capital position than their global peers. The Australian banks should continue to provide attractive dividend yields for investors also, and this will be confirmed when our banks report their results next month.
Yeah, those banks are on quite attractive yields there, Dan, between 5 and 10%. But with tougher economic conditions on the horizon and higher interest rates, we do expect corporate bankruptcies to rise as well. Only recently, skincare and beauty retailer BWX Group, now you might know them for popular brands like Sukin and Mineral Fusion, they've left many investors facing significant losses here. Now, BWX, they faced issues like higher inventory levels. They had soaring debt levels and also questionable financial accounting, which contributed to their collapse. And the companies had liabilities exceeding their assets by 40 million and a staggering 963% of net debt to equity ratio. And that's inclusive of their lease liabilities as well.
That's exactly right, Ken. And the signs were there as years before its collapse, the short interest rose to around 14% at the end of 2018. Another retailer on the brink of collapse is Mosaic Brands, which are the owners of Non-B, Millers and Rivers. The company has recently placed its multi-channel retailer Easy Buy into administration and is also struggling with high debt levels.
Wow, Dan, so many companies look vulnerable here, but retailers are not the only sector at risk. You have also this group called Sea Farms Group, a prawn farming business. And they've moved their flagship project, Sea Dragon, into voluntary administration. And this company continues to rely on capital raisings to stay afloat. Now, with about 75% of companies on the ASX currently listed as financially unhealthy, it's important to ensure at this time that you don't have these zombie companies within your portfolio. And speaking about the food and wine sector, Dan, and you spoke about, your trip to Adelaide and the wineries there. China has stated that it is willing to resolve its tariff disputes over Australian wine and barley exports. So this is great news for borderline star growth stock Treasury Wine Estates, and should allow them to regain market access to China.
Absolutely, Ken. And it's important to remember that before the tariff disputes, China accounted for around 30% of Treasury Wine's earnings in 2019. So the resolution of this trade dispute could lead to an increased market share and strong brand recognition, which will ultimately lead to an improvement in its return on equity and net profit margins as well.
Yeah, China certainly likes those Penfold brands there, Dan. But turning our attention now to the week ahead, we have Bank of Queensland. They were reporting their interim result on the 20th of April. While wealth platform Hub24 will be releasing their March quarter update on the 18th of April. These will be interesting updates given that both have been subject to increasing volatility in recent weeks. Bank of Queensland on the back of the global banking crisis, and also Hub24 on the back of that negative update from Netwealth. But Bank of Queensland is expected to pay a gross dividend yield of 11% with the ex-dividend date in early May. And now for Under the Microscope. This week we take a closer look at wealth platform Netwealth. They did release their March quarter update last week, and despite additional net fund inflows, the stock price faced quite an adverse reaction on the day. So Dan, can you tell us a little bit more about this?
Yeah, absolutely, Ken. And while the operational performance of the business actually was quite robust, management lowered their FY23 net fund inflow guidance previously from $11 billion to a range of between $9 and $11 billion. And this has marked the second downgrade to the group's net fund inflow guidance for the year. However, it is important to note that the key driver behind management's softer fund inflow guidance is premised more so on clients' hesitancy to roll over their funds onto the platform during times of market volatility. And this trend also emerged in past periods of volatility, such as during the COVID pandemic, the Fed pivot in 2018, and also the US presidential election in 2016 as well.
Yeah, very interesting, Dan. There seems to be a correlation between fund inflows and also market volatility. And given that the markets have somewhat stabilized in recent weeks as inflation and interest rates begin to cool, the improved market conditions could potentially support a resumption in fund inflows for Netwealth then, shouldn't it?
Yeah, potentially, Kien. And this is why we don't see the revised fund flow guidance as a material risk to the group. In fact, the account fees generated from these additional fund flows are not a major component of their revenue. The stronger drivers of earnings growth for Netwealth will be determined by the cash management fees charged on clients as cash account balances, which of course are rising due to the higher interest rate environment, and the growth of new accounts on the platform, which is up by around 11% over the past 12 months.
Yeah, Netwealth certainly is benefiting from that rising interest rate environment. And these contributing factors are behind the group's estimated earnings growth of around 23% in financial year 23 and 25% for the year later. Meanwhile, also, I noticed that the softer fund flow guidance, it really hasn't had a material impact on consensus earnings estimates or revisions there. And I noticed that the founder remains a key driver of the business, Dan. So it's vital also to observe Golden Rule 7 principal activities for any change in director holdings. From what we can see, though, there was a 4% decline in Heinz holdings over the last 12 months following a share sell down post the group's August 2022 result. Is there a cause for concern here?
Yeah, look, Ken, while sometimes it could be a potential yellow flag, the Heinz family still retains over 50% of equity in the company. So therefore, their interests are very much aligned with shareholders. And considering that they held around 63% of the company at IPO in 2017, the pace of the sell down has not been something we are overly concerned about at this stage.
Now, earlier in the episode, we did allude to the fact that inflation, despite slowing down, is still well above the central bank's target range of around that 2% level. And investors, they tend to view gold as a hedge to inflation. So over the last few months, we have seen the gold price rally quite strongly. So a good question for investors this week is, how much gold exposure should investors have in their portfolio?
That's right, Ken. And the rally in gold price in recent weeks has been driven by a number of factors. Apart from being an inflation hedge, gold is also considered a safe haven asset, which has benefited from the global volatility in the banking sector. Secondly, gold is denominated in US dollar, and the falling USD has made gold cheaper in other currencies, which is therefore driving higher global demand for the metal. Lastly, gold has become more attractive as investors anticipate an end to these rate hikes. And now a peak in interest rate rises may have slowed that transition out of gold towards higher yielding assets, such as cash and bonds.
Quite interesting there, Dan. But from a portfolio perspective, though, it does make sense to have some exposure to gold, which can help diversify your portfolio. Remember, gold miners, they have high correlation to gold prices. And but the thing is, they also tend to be quite volatile. For instance, they could rise by more than the gold price when gold prices rally. Hence, around a rough 10% exposure in your portfolio would be ideal, but no more than 20%.
Absolutely, Kien. And to mitigate risks further, investors should focus on those gold producers which have strong cash flows, high quality assets, and low operating costs, and an increasing production profile over the long term. From Stock Doctor's standpoint, these attributes are reflected in having strong financial health, high returns on invested capital, and also robust earnings quality. Good example include our Star Gold stocks, Gold Road Resources, and also Alkane Resources.
Yeah, interesting insights there, Dan. Appreciate you coming on board today, especially after your break.
It's been fantastic, Ken, and an interesting week for investors, that's for sure.
And also, if you do have any questions regarding this episode, please come along to our Lincoln Live webinar on Monday, where our team of experts, including our Chief Investment Officer, Tim Lincoln, Senior Portfolio Manager, Matthew Swartz, and our technical expert there, Rob Manfrey, and of course, myself will be on call to answer any questions. Also, of course, if you are finding Stock Doctor valuable as well, feel free to introduce it to your family or friends so they too can invest with confidence and success, especially during this challenging and volatile environment. To summarize today's episode, inflation and interest rates, they appear to have peaked, but a global recession doesn't necessarily mean markets will fall. Rather than try to time markets, really focus on the risk management of your portfolio, what you can control. Be diversified and invest in those quality companies that can continue to generate profits and dividends in this challenging economic environment. Take care and have a happy, healthy, and prosperous week ahead, everyone.